Hi, I'm Kylie Matu and welcome to Wealthy Millionaire. Today we're going to talk about how to calculate your mortgage payments. Buying a house can be a really intimidating process, especially when you have to consider how much you can afford. There are some specific factors to consider that will help you navigate this process and remain within your budget. Let's take a look at how a mortgage calculator can help you. Determining what your monthly house payment will be is an important part of figuring out how much house you can afford. The monthly payment is likely to be the biggest part of your cost of living. Using a mortgage calculator lets you estimate your mortgage payment when you buy a home or refinance. You can change loan details in the calculator to also run scenarios. The calculator can help you decide the home loan term length that's right for you. So a 30-year fixed rate mortgage will lower your monthly payment, but you'll pay more interest over the time of your loan. A 15-year fixed rate mortgage will reduce your total interest that you pay, but your monthly payment will be higher. Another good option is an adjustable rate mortgage. You start with a teaser interest rate and then the loan changes higher or lower over time. This can be a good choice, especially if you plan on being in a home for only a few years. You'll want to be aware of how much your monthly mortgage payment can change when the introductory rate expires. If you're buying too much home, the mortgage payment calculator can give you a reality check on how much to expect to pay each month, especially when considering all the costs including taxes, insurance, and private mortgage insurance. Another great thing about the mortgage calculator is it can guide you on putting enough money down, with minimum down payments commonly as low as 3%. The mortgage payment calculator can help you decide what is the best down payment that may be for you. So when calculating your mortgage payment, it's going to include more than just the basic cost of your principal, loan, and interest. Here are some of the primary components that factor into your monthly mortgage payment. So first we have the principal. This is the amount that's outstanding on the money that you borrowed. Part of the monthly payment will go towards reducing this amount. Second, we have interest. These are extra charges that you might pay to the lender for borrowing the money. We also have property taxes. The government authorities assess the annual tax payable on your home, and this amount is divided by 12 and is added to your mortgage payment. We also have homeowners insurance. So this is a policy that will cover you for financial loss and damage to your home, for example, from fire, storm, theft. The annual premium is broken down into 12 parts, which you'll pay each month. And last, we have mortgage insurance. So that if you'd made a down payment that was less than 20% of the price of your home, you'll likely have to pay a mortgage insurance to protect the lender against default. So once your equity increases to more than 20%, insurance should no longer be required. The first place you want to start is to calculate your revenue streams. So that's how much income you're bringing in each month. You can start with your primary salary, but you're also going to include your monthly income. So that includes anything from part-time earnings, investment earnings, social securities, or any other regular income streams. If you're buying with a partner, include their monthly income as well. You'll be using your gross monthly income and this income that has been earned before accounting for any taxes. Now that we've taken all costs into account for purchasing a home and taking out a mortgage, we know it comes with many expenses beyond paying the principal and interest of your mortgage. As I already mentioned, taxes, home insurance, and mortgage protection insurance. They're all ongoing costs you're going to have to pay, and a mortgage calculator allows you to factor in these costs accurately to determine what you can afford. So another thing we want to do is make sure we're always choosing the right home. Knowing your price range allows you to focus on homes you can afford, and you're not wasting your time on properties that go beyond your limits. Buying above your budget is a mistake, and that could have costly effects for you for years to come. So it's vital to only commit to what you can afford. So let's take a look at a mortgage calculator with a few examples of your options. Let's put in a $500,000 mortgage with an interest rate of 5.5%. And we'll start with a down payment of 20% and a 30-year term. So now you can see here the loan after the down payment is $400,000 The down payment is $100,000 and the monthly payment is $2,271 with 360 payments. And since we're putting down 20%, we will not have to pay for private mortgage insurance. An average tax figure for your purchase will be about $10 for every $1,000 assessed per year. If the assessed value of your home is 85%, this will make your home's assessed value at $425,000 and your monthly tax around $354. You'll also need homeowner's insurance to factor in. So here is an average of $56 per month. So now with everything added together, your monthly payment will be $2,681. Now let's try with a smaller down payment. We'll do 5% and keep our 30-year term. So we have here our 5% down, 5.5% interest, 30-year term. Our loan after our down payment is $475,000. Our down payment amount, $25,000. Our monthly payment is $2,697 with our total payments of $360. So now you'll see here, because we're paying less than 20%, it means that we will need mortgage insurance. And this averages around $55 for every $100,000 borrowed. So an estimate for the mortgage insurance will be around $261 per month. Our average tax figure of our purchase will be $10 for every $1,000 assessed. The assessed value of your home is 85%, and this would make your home's assessed value at $425,000. So our monthly tax will be around $354 a month. Our homeowner's insurance, again, will be approximately $56 per month. And with all these factored together, our mortgage payment estimate is around $3,368. Now let's go back to our 20% down. But if we want to pay this off in a shorter amount of time, let's put in 15-year term. You can see here with our $100,000 down, which is 20%, our loan now goes down to $400,000. Our monthly payment is a little bit bigger now because we're trying to pay it off in a shorter amount of time. So $3,268. And now our payments are only 180 payments in our 15-year term. Since we're putting down 20%, we don't have to pay the mortgage insurance. Our monthly tax is around $354 a month. Our homeowner's insurance, approximately $56 a month, which is bringing us to a monthly payment total of $3,678. Let's try that with only 5% down. So with 5% down, we're putting down $25,000. It's brought our loan down to $475,000, 180 payments, 15-year term, and our monthly payment is $3,881. And now that we've put down less than 20%, our mortgage insurance is approximately $261 per month. Our monthly tax will be around $354 a month. Our homeowner's insurance approximately $56 a month, with our monthly total of $4,552. So lenders must assess whether or not that you can pay your mortgage. They'll take many things into account, but the main factor that they'll consider is your debt to income ratio. Your debt to income ratio is a percentage of your income that goes towards paying your debt each month. Most lenders prefer that your loan payments, including your mortgage, student loans, credit cards, personal loans, all be less than 36% of your monthly gross income. A low debt to income ratio means that you're better off, in a better position to easily pay back your loans. If you'd like to reduce your monthly payments, you should try changing factors such as your mortgage interest rate, term, and down payment. Using the calculator, you're going to be able to see how you might be able to save some money. Here are some factors you should try and consider. Extending the term of your mortgage will reduce your monthly repayments, but increase the amount of interest you pay over the life of your mortgage. Increasing your down payment will decrease the size of your mortgage. It may also qualify you for lower interest rates. Both of these factors will reduce your monthly payments. Finding a lower priced home could reduce the amount you need to borrow, and the result, lower monthly payments. And shopping around for a lower interest rate can dramatically decrease the expense of your mortgage in the long run. As I mentioned before, your payments can go up, so always keep in mind that several factors can cause your mortgage payments to go up in the future. Taxes and insurance premiums can go up, which would increase your monthly payments. A late payment could also result in a fee. Increases in interest rates on an adjustable rate mortgage will increase your monthly payment. It is vital to take into account that your monthly payment could increase over time. You should leave enough flexibility in your budget to be able to handle the extra costs. Taking out a mortgage is likely the most significant financial decision of your life. Before making this huge commitment, you should be sure that the mortgage you choose fits your budget. I'm Kylie Mathieu, and thank you for joining Wealthy Millionaire.